All right, so now we want to look at Chapter 9. Notice that we've gone down the left side of the balance sheet looking at the various kinds of assets, and now we're going down to the right side looking at liabilities. So here we're going to talk about current liabilities, and then Chapter 10 we'll talk about different types of long-term liabilities. All right, so let's describe both and their characteristics. First of all, liability is an obligation that is due to some past event. It's a present obligation, I guess I should say, due to a past event. And there's going to be some sort of future sacrifice of either money or services or goods to satisfy it. If you don't have these three elements, you don't have a liability. And liabilities can be classified as either current or long-term. It's current if it's expected to be satisfied within the next year or the company's operating cycle, whichever's longer. And of course, long-term liabilities are going to be obligations that are satisfied in more than 1 year or operating cycle, which is ever longer. And you can have actually a debt that can be both short-term and long-term. For instance, note payables. When you have a note payable, you have an obligation that you're going to have to meet. Normally, when you have like a note payable, you're going to be paying monthly payments. And so the payments that you make towards the principal amount over the next year is going to be considered what they call a current portion of long-term debt, and then whatever's going to be paid after that year is reported as long-term debt. Well, sometimes you have uncertainty with liabilities. Those uncertainties can be exactly whom to pay, exactly how much to pay, and when to pay. Usually you don't have uncertainty as to whom to pay, but they give this example that I've never seen before in my life. You could have a liability where you issue a note payable to its holder, and you don't know who the holder is going to be at the time you pay the note. Again, I've never seen this before, but apparently it exists out there. As far as when to pay, again, you could pay with money, you could pay with services, you could pay with goods. You're meeting an obligation, right? Pay indicates a payment of cash, but the payment could be in service, or satisfying the obligation could be in providing services or goods. And so, for instance, when you have a prepayment for services, such as a law firm might receive a prepayment for services, they're going to list it as an obligation, prepaid revenue, and they may not know exactly when they're going to satisfy that future obligation. In other words, they don't know when they're going to have to provide services to this client by rendering legal services. And last but not least, you might have a situation where you have uncertainty as to how much to pay. And so this might be an instance where because of the end of year coming up and you haven't received a utility bill, the company's got to accrue an expense through the end of the year for that utility expense. Somehow they're going to have to estimate what the accrued expense will be if they haven't gotten a bill yet. So let's talk about known current liabilities. Here are some examples of known liabilities. Accounts payable, we've already discussed when we talked about merchandising operations. We'll look at sales taxes payable, unearned revenues we've looked at, short-term notes payable, payroll payable, and multi-period known liabilities. All right, so sales taxes payable, understand what sales taxes are. If you're obligated to collect sales taxes, that's not the company's money. That belongs to some governmental agency, and you're obligated to hold that money and pay it over to the governmental agency at some point. And so you don't get to use that money. And so here we have a situation where Home Depot sells materials for $6,000 and is subject to a 5% sales tax. So they're going to charge the customer the 5% sales tax. They're collecting it from the customer, and they're just holding the money waiting to pay the governmental agency. And so 5% of $6,000 is $300, and so they collect $6,300. They recognize sales revenue of $6,000, and they list the sales taxes they collect as sales taxes payable, and at some point they'll pay that out by debiting sales taxes payable and crediting cash. Usually you have to pay it over each month at some point. Recall that unearned revenues, you've got to book the unearned revenue as a liability. So here we sell $5 million in tickets for 8 concerts. You book the $5 million collected as unearned ticket revenue, and since it's for 8 concerts, as each concert is performed, they recognize 1/8 of $5 million in ticket revenue. Short-term notes payable, we kind of looked at that when we talked about short-term notes receivable. It's just the flip side of this. You're the one paying the note payable, and so remember, it's a written promise to pay a specified amount on a future date within 1 year, whichever is longer. And recall, it has a maturity date, it has an interest component, it has a principal amount due. And so here you have a situation where you have negotiated with one of your creditors to turn a note, or excuse me, an accounts payable into a note payable, And so you already had the accounts payable on your books. Here you're going to back that out by debiting accounts payable for this creditor. And in this situation, you've agreed to pay him $100 now and pay $500 over a 60-day period at 12% interest. So you credit cash and you add the notes payable to your books by crediting notes payable. And so on October 22nd, you pay the notes payable on the $500 you owe. And so 60 divided into 360 is 1/6. And 1/6 times 500 times 12%, well, 500 times 12% is going to be $60 times 1/6 is going to be $10 of interest expense. So note payable, you're going to back out by debiting it. You're going to debit interest expense for $10, and of course you're going to credit cash for $510. Same idea for a note given to borrow from a bank. It's the same concept. And so this is payable 60 days within the same year's period, no problem. It's just like what you saw before. The problem comes when you come up to the end of the period and you haven't paid the note off. What you have to do is you have to accrue an interest expense for the unpaid interest for the year. And so you have to make an adjusting entry at the end of the year. And so here you have a situation where on December 16, the company borrows $2,000 from a bank at 12% interest, basically the same example as before, just a different day on when you borrow it. You borrow it 15 days from the end of the year, and so you're going to have to accrue 15 days worth of accrued interest as interest expense through the end of the year. So 2,000 times 12 is $24 times 15 over 360, and so that's going to be $10. And when you pay it in that next year, you're going to accrue $30 additional interest for the interest from January 1 through February 14. So that's the $30 interest expense. You're going to back out your interest payable from the December 31st entry, and of course you're paying the note, so you're going to back out the note payable by debiting it, and then you're going to credit cash for 2040. All right, let's talk about employee payroll deductions and liabilities. We'll talk about employer payroll deductions and liabilities here in a minute. Well, employer liabilities are not really payroll deductions. So just understand that employers incur liabilities or expenses and liabilities from having employees, and so what they are varies from company to company, but whatever the payroll deductions are, they result in a reduction of gross pay to net pay. Now, some of the more common payroll deductions are federal income tax. That's certainly true of all payroll deductions. State and local income taxes, maybe voluntary deductions, maybe. FICA taxes, Medicare, and FICA taxes, Social Security, definitely. Um, so it kind of depends. Well, what are FICA taxes? Well, FICA taxes are actually two components. You have your Social Security portion of FICA taxes, and that is 6.2% of the first, it says 118,500, that's for 2016. That's been bumped up to 127,000 for 2017, but we'll go with the 2016 numbers here, which is just fine. You know, we don't have to use 2017 numbers. And so you have to deduct 6.2% of each employee's paycheck, gross pay, and deduct that and pay it over to the U.S. government. Now, that's on each employee's income up to the first 118,500 in 2016. Now, for the Medicare portion of FICA taxes, you must deduct 1.45% of all of an employee's wages earned in the year, and there's no cap on it. It's applicable to all wages earned by each employee. Now, the employer this is just like sales taxes. You have to deduct these from the employee's paycheck, and you're going to list it as a liability, a payable, and it's payable to the U.S. government, to the IRS, at some future date. It's not the company's money. You're holding it in trust for the U.S. government. On top of FICA taxes, you've got to withhold employee income taxes, which definitely you have to withhold federal income tax, and depending on the location, you may have to deduct state and local income taxes. And the amounts withheld depend on several different things: the employee's earnings, their tax rates, and the number of withholding allowances for each, well, the taxpayer, spouse, and each dependent. And so there are tax tables built into the software that companies use for payroll to figure out these amounts that have to be withheld. Again, you have to, the employer has to withhold these and pay them over to the federal or state and local government the amount that's due them. And so this would be federal income taxes payable, or state income taxes payable, or local income taxes payable. Voluntary deductions could be due to union dues, some sort of savings account, pension contributions, insurance premiums, or charitable contributions. And the employers have to hold these monies in an account and pay them over to whatever company or agency is designated. All right, so here we have an example of a typical payroll deduction journal entry. Here you've got an employee who earns $2,000 um, in pay during this period. And again, the accounting software would take care of this stuff, figuring out the amounts, but I mean, it's not too hard to figure out 6.2% of $2,000. So FICA, Social Security taxes payable, is credited, therefore deducted from this employee's paycheck. FICA Medicare taxes payable, $29 credit. Employee federal income taxes payable. You've got medical insurance payable, union dues payable, and whatever else is left is the salaries payable to that employee or employees. Now, in this case, it's just one employee, but it could be multiple employees. Now, on top of deductions from the employee's paycheck, employers have liabilities as well due to payroll obligations. Not only does the employer have to withhold FICA taxes from the employee's paycheck, but the employer has to match that number, the 6.2% and the 1.45%, and that doesn't come out of the employee's paycheck. That comes out of the employer's pocket. And of course, for Social Security, they pay 6.2%. They have to match the employee's 6.2% up to that cap for Social Security. And again, Medicare, there is no cap, so they're responsible for 1.45% on all of an employee's pay. On top of those two things, the employer is responsible for paying federal and state unemployment taxes. And for simplification, the total of federal and state unemployment taxes is 6% of an employee's pay, with 5.4% of that going to the state unemployment tax, and the other 0.6%, which you would calculate actually as 0.006%. The 5.4% would be calculated at 0.054%, using a, when you're calculating on a calculator. Don't get confused, because you'll come up with some pretty big numbers if you get confused. Now, this federal and state unemployment tax is taxed on the first $7,000 of wages paid to each employee. And like I said, a credit of 5.4% is given to the state unemployment taxes, and usually the state gobbles up that whole 5.4%. So you can just assume in any problem that the state unemployment tax is 5.4% of the first 7,000 of wages paid to each employee, and that the balance of that 6% or 0.6% goes to the federal unemployment taxes. So here you have a typical situation like what we were talking about. You've got payroll taxes expense, which is determined from all of your obligations of the employer on this employee who made $2,000 during the period. So that's where they're coming up with that. And notice that the FICA Social Security and FICA Medicare taxes payable are the same number. It's a matching number as was taken out of the employee's paycheck. And of course, again, the federal and state unemployment taxes payable are paid by the employer, not the employee. So it comes out of the employer's pocket. And so 2,000 times 0.054% is $108, and 2,000 times 0.006% is $12. So the sum of all these numbers in the credit column equals payroll taxes expense of $273. Some notes on internal control of payroll. 4 key areas, because this can be a real source of fraud. You could create fictitious employees if you're working in payroll, and take that, get a fake ID, cut a check to the phantom employee, take your fake ID and go open an account, and just keep paying the phantom employee and cashing the checks. And so some controls to take care of this. Have some controls on hiring as far as authorization to hire and the authorization to fire. And so that keeps fake employees off the payroll. As far as payroll preparation, make sure that your payroll tax rates and amounts are up to date. As far as timekeeping, there your duty is to track and verify the time worked of each employee, and so that you're only paying for time worked. And then as far as the payment of payroll, you want to have an authorized signer, and you want to issue pre-numbered checks, or many times what you're doing is EFT transactions directly into an employee's account these days. Sometimes you have multi-period known liabilities. And again, an example would be unearned revenues or notes payable. Unearned revenues from magazine subscriptions would be a situation where they prepay for more than one period. Let's say two years prepayment. You're going to have a current portion of unearned revenue, and you're going to have a long-term portion of unearned revenue in that case. And like I mentioned, the same for notes payable. The amount of principal that you're going to pay within the next 12 months is going to be current portion of notes payable, and then the rest is going to be your long-term liability. Sometimes you have estimated liabilities, and the one we want to talk about here is warranties. And so this is when you have things like warranties, it's a known obligation, but the amount's uncertain. However, from past experience or history, you can reasonably estimate the liability. So let's look at warranty liabilities. So this comes about due to the obligation to replace or correct a product that fails to perform as expected within a specified period. When a seller sells a product, it's very common for them to offer a 1-year product warranty. And if anything goes wrong with the product within that 1-year period from purchase, the buyer can either have it repaired or replaced. And so the seller, either at the time of sale or at the end of the year in which the sale occurs, they need to report the expected warranty expense in that period. And they report this warranty obligation as a liability. And so here you have an example where a car dealer sells a car for $16,000 with a 1-year or 12,000 mile warranty covering parts. Past experience indicates that warranty expenses average 4% of a car's selling price. So 4% of $16,000 is going to be $640. And so they could do one of two things. They could, on the date of sale, go ahead and estimate the warranty expense for this car, or they could wait till the end of the year and just do it for all cars sold during that year based upon the same idea of 4% average on each car's selling price. Now, let's say that this particular customer comes in after the year, on in the next year, and needs some repairs. Well, they've already booked the estimated warranty liability for this car. They're simply going to do the work, back out the amount of the work done out of the estimated liability account. So debit estimated warranty liability, and if it's parts, they're going to credit auto parts inventory. And they don't even book the service amount. Now, what happens if you are extremely over or under on your estimated warranty liability? Well, just like anything else that is an estimate, such as bad debt expense, management has to look at this, and if they overestimate by quite a bit, they need to change their estimation down. And if they underestimate, they need to adjust their estimate up. So you just react to it accordingly. Well, what about contingent liabilities such as lawsuits? How do we handle that? Well, it depends. And so it depends on whether the future event is either probable, possible, or remote. Well, what the heck does that mean? Well, probable means, let me get to it here. That it's likely to occur. Now, if it's likely to occur, you have to also determine whether or not the amount of the contingent liability is estimable. If it's estimable, you have to record the probable liability in your balance sheet as a liability. Well, what if it's probable but you cannot estimate the amount of the liability? Well, you're simply going to disclose the nature of the liability and the fact that it's probable in the disclosure notes that come with the financial statement. If the future event is possible, meaning it could occur, you're simply going to disclose in the notes to the financial statement. And then, of course, if it's remote, meaning it may or may not happen or it's unlikely to happen, we don't do anything with it. No disclosure, nothing in the balance sheet, nothing. So here's some examples of those types of liabilities. Legal claims, lawsuits with companies, especially large ones, are usually a big part of the disclosure notes and possibly even recorded in the balance sheet as a liability if it's probable and estimable. All right, so that's it for Chapter 9. Next time, Chapter 10. That will be our last chapter of this term.